Executive consultants, you're welcome. In our previous video, we stopped when we are calculating the goodwill for the group. And now we are going to continue from there. And then we continue looking at other calculations. We must remember that in our additional information, we are told that the investment in American Express goodwill impaired at 2,800. That simply means we need to calculate goodwill for the associate as well. So there are so many methods of calculating goodwill for the associate, but let us use this simple one of us saying the cost, and then we put the percentage share of the parentage on the net assets, and then we'll get the goodwill. So our cost, like we saw in the question, it is to come back, it is here, and it's 224,000 shillings. So we'll come and then we'll put out 224,000 shillings, and then we'll put the percentage share of the parent. Remember, we have 30% influence. So we'll come and then we get to know the parentage share, and which is here. So when I do that, then you can clearly see that we get the goodwill of the associate by simply saying, because we are lessing, so we need to put this negative as well. And then we are simply going to say equals to sum. And then we'll say, so our goodwill for the associate is 14,000 shillings. We'll get back to this when we are calculating the cost and then the group retained earnings later on. So we'll move on to working for, which is NCI. And like we've been doing, so we'll simply say NCI, and it is NCI percentage of the net assets at the reporting date. So we'll say 20%, we'll say equals to 20% times the value at the reporting date. And we'll have that. And then we'll add on our goodwill NCI, which is 200 shillings. And then we'll have as our total NCI value as a summation of the two. And we'll say, so that is our NCI. And as simple as that, just like we saw in IAS27. So we come here to group retained earnings, and you've been knowing that we always check 100% of the retained earnings. Why? Because the pre-acquisition retained earnings of the subsidiary are going to be effectively cancelled out with a cost. So we'll come and then we get to know what is the retained earnings for the parent, and it is 1,232,000 shillings. So we'll put 1,232,000 shillings. Okay, it's in US dollars, but it's okay. Then parent's share on the post-acquisition of the subsidiary. So we'll still put our 80%, and then we come back to our profit that we got. And then we'll also do the same. So the reason that's why I've always been telling you to always first get to the post-acquisition, you're saving time. Now that we already know that we made a profit, we are saving time. We're simply multiplying with what we already got from the beginning. So here we'll simply say 30%, then multiply it with the post-acquisition, and then we will less the goodwill impairment. Now, the goodwill impairment here, I must put that it is for both the associate plus the subsidiary. But because we know it is only the subsidiary that got impaired, so we'll simply put the value of 2,800 shillings. And we will be arriving at our total group retained earnings by adding up all these, and then we less the 2,800. So once that is done, then we'll move on to the final bit of our calculation, which is the cost of investment in an associate. There are so many methods, but let us still look out for this, which is easy. So our cost, like we know here, we can see it is still here. So we'll take it up, and then we'll say our parent's share on the post-acquisition profit. We also have that already. So we'll simply come and we put this there. But because it is in negative, we need now to put up, we'll simply need to feed it manually. So we'll simply come and then we still say equals to 30% times what we got here as our post. And once that is done, we also say less the goodwill impairment of 2,800. Then we'll have our cost of investment in the associate as summation. Okay, so we have everything done. So it's just a matter of us filling in this. So we will come and then I will get our totals. So we'll start with the non-current assets. Remember, we are not going to include the associates assets and liabilities, because we only include the cost of investment only, but the rest we ignore them because we don't have control over them. So we are going to add our 1 million with our 1,120,000 plus 980,000, so that we can arrive at our figure. So we'll come and say net current asset equals to 1,120,000. We need to be certain of the figure. Okay, 120 plus 980,000. Okay, our cost of investment, we have it already, so we'll simply come and pick it up from here. And then we have our goodwill as well, so we'll come and we'll put it up here. Someone might ask, why have we ignored the goodwill of the associate? The only item of the associate that we include in our assets by the standard, as regarded by the standard, is the cost of investment in the associate, which is here, our current assets. So we are simply going to add up all those. We are going to add up all the associates, all the current assets of the subsidiary, and then the current assets of the, and all the current assets of the, so we will come and I will get to our current assets. So you are going to include the inventory, the receivables, and cash. So 380,000 plus 640,000 plus 190,000 plus 310,000, then plus 35,000, that is cash, and then plus 58,000 for their subsidiary. Then we will get our value as 1,613,000. And then we'll have now to get our total assets, which will going to be summation of all this. And once that is done, let's put commas so that it can look organized. So we have that. Then we'll come to our equity, and we know we are taking 100%. Just a moment. We are taking 100%. We are taking 100% of the parent's share capital. So it's 1,120,000. So we'll come and we'll put 1,120,000. Then our group retained earnings, which we already have in our working 5. So we'll simply come and we put it there. And then we will have our NCI. Let's add in our NCI. So we'll put in our NCI, and we have it here as well. And then we'll get our total for equity. So we'll say sum, then boom. Okay, so we'll come to our liabilities, and then we'll come to our liabilities. We're still going to take up everything at the same like we did for the assets. So 150,000 plus 480,000 plus 91,000, then plus 66,000. And then we'll have our total value for the assets. For the total liabilities, 787,000. So we'll currently ignore maybe this, and then we'll ignore this as well, so that we have an organized kind of work. So let's put in commas, and then we'll see our total equity plus liabilities, what it gives us. So we'll say sum, and then we'll say this, and then this. Okay, so we can see that we have our total assets as that, and then we have our total equity and liabilities as that. And by accounting principles, the accounting equation says that total assets equals to total equity or owner's equity and liabilities. And we have fulfilled the condition. So this is how we do IAS28. Because IAS27, we are simply looking at a parent and a subsidiary, but under IAS28, we now have three of them: the parent, subsidiary, and then the associate. So today's class is going to stop here. And in the next class that we are going to look at, we are going to look at the consolidated income statement or the consolidated profit and loss account. And for any questions, for any inputs, for any corrections, kindly put it up in our on our comment section. We'll be getting back to you. It's always good to get feedback. So kindly, for any questions, for anything that you might probably not have understood, you can get back to us using the contacts just on our poster up here. Executive consultants, let us learn together.